Hi there, very good morning. Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar and Srishti Sharma. And over the next 1 hour, we'll take you through all the global and domestic cues that you must watch out for and also tell you about the stocks that you need to keep on your radar today. So let's get started with an eye on the globe and see how Wall Street fared overnight. And it was a mixed session that we saw overnight on Wall Street with some profit-taking happening after fresh record highs that were seen in intraday. The S&P 500 that slipped about 0.3%, while the Dow Jones Industrial Average that fell more than 460 points, or roughly about 1%, even after both of these indices touched their new all-time highs earlier in the session, that is intraday. The tech-heavy Nasdaq Composite that actually bucked the trend, rising nearly 0.2%, helped by a 2.5% jump in Alphabet that we saw. Now remember, the Google parent briefly overtook Apple to become the world's most valuable company for the first time since 2019. And despite the ongoing geopolitical tensions, markets have largely remained resilient, and in fact analysts are now saying that geopolitical risks, they tend to move markets only briefly before investors refocus on fundamentals like earnings, margins and valuations. So yes, that's about the markets, but looking ahead, investors are going to brace for potential volatility later in the week, with the Supreme Court expected to issue opinions on the legality of the tariffs that were imposed by President Donald Trump, which is the key headline risk that could move the markets. So yes, that's how the Wall Street is looking, Srishti. Mixed moves over there, but a key week. The legality of tariffs is something that we'll watch out for in the remaining week. But how are things looking on the crude front?
Quite interesting, Kanishka, because with respect to the crude oil prices, we have seen the inventory data coming in, as well as the crude is seen to be rising after the 2-day of decline. As of now, WTI crude is trading above that $56 per barrel mark, while a slight uptick overnight is what we have seen on Brent oil as well, where the market is been assessing the fresh US actions in Venezuela, because US to take long-term control over Venezuelan crude sales. And yes, of course, the fresh commentary coming in from Trump as well, that wherein how that money is going to be utilized from all that Venezuela will get from the purchases of the crude oil that US will make, and yes, vice versa, the companies will try to make an investment and make purchases of the US products as well. But for crude oil prices, quite interesting moves, and along with that, silver has seen a decline of almost 3.5% overnight, while crude is trading absolutely flat for now.
Right, so that's about crude and metals, but let's move on and also tell you about some top stories that we're tracking this morning. First up, Trump says that America's 2027 military budget that should jump to $1.5 trillion. That's up from earlier $1 trillion plan. Now, Trump argues that tariff revenues make the increase affordable, also promising a dream military that will be stronger national security for them. Debt reduction will also be happening across the US, and also cash dividends for middle-income Americans. That's what he has in sight.
All right, but the next story is with respect to European markets, because European stocks did slit as geopolitical jitters surged, yet defense shares rallied, because for a fourth straight session amid the renewed US interest in acquiring the Greenland, Trump is actively exploring the options to secure the strategic Arctic island and citing security against Russia and Chinese influence, where Denmark and European allies strongly oppose any annexation. But let's listen in to Caroline Levitt, who is the U.S. press secretary.
The acquisition of Greenland by the United States is not a new idea. This is something that presidents dating back to the 1800s have said is advantageous for America's national security. The president has been very open and clear with all of you and with the world that he views it in the best interest of the United States to deter Russian and Chinese aggression in the Arctic region. And so that's why his team is currently talking about what a potential purchase would look like. More control over the Arctic region, and ensuring that China and Russia and our adversaries cannot continue their aggression in this very important and strategic region. And there would be many other benefits as well.
All right, so those were some defense-related updates from the US and EU. But now let's shift focus to US's real estate space. Now, Trump says that he will push to ban large institutional investors from buying single-family homes, arguing that the housing should be for people, not corporations. Trump plans to ask Congress to codify the move that's aimed at easing affordability pressures. Now, markets did react very swiftly. Shares of Blackstone, which is a major property buyer, fell by over 5%. In fact, analysts are questioning whether such a ban would materially lower home prices.
All right, but with respect to Venezuela, Trump says that Venezuela has agreed under a new oil deal to spend oil proceeds on American-made products, including agriculture, medicines, medical devices, and energy infrastructure equipment, positioning the U.S. as a Caracas' principal commercial partner, where the announcement follows U.S. move to export Venezuelan oil and manage its revenue were part of an aggressive push to reshape the bilateral economic ties. But with this, let's also listen in once again to Caroline Levitt, U.S. Press Secretary, on the same.
The United States government has already begun marketing Venezuelan crude oil in the global marketplace for the benefit of the United States, engage the world's leading commodity marketers, key banks to execute and provide financial support for these crude oil and crude product sales. All proceeds from the sale of Venezuelan crude oil and products will first settle in U.S.-controlled accounts at globally recognized banks to guarantee the legitimacy and integrity of the ultimate distribution of proceeds, and those funds will be dispersed for the benefit of the American people and the Venezuelan people at the discretion of the United States government.
All right, so let's keep it with the oil space. Now, U.S. forces, they've confirmed seizing a Venezuela-linked oil tanker in North Atlantic. Now, U.S. officials have said that it is a sanctioned oil tanker. Some reports state that it's a Russian-flagged oil vessel. Now, as per reports, the U.S. has been pursuing this tanker since the last month after it tried to evade a U.S. blockade around Venezuela. Certain reports have also stated that the tanker was earlier known as Bella 1 and was re-registered as a Russian vessel named Marinera to evade seizures. Now, Russia has reportedly deployed a submarine to help escort it across the ocean. In fact, we caught up with Robin Sachdeva, who is a foreign affairs expert, to understand what this really means. Let's take a look.
Well, thank you so much. You use an interesting word to stir the pot. So we can summarize. The year 2026 is going to be a hot pot. Absolutely. And they will be stirring of the pot. It's very clear. Now, what we are seeing here right now is that, America, what it has done with Venezuela right now, has clearly said that this hemisphere is my hemisphere. No one else can come or go out without my consent. And that is it. So right now, by the way, this tanker is not carrying oil. It was going towards, it was going towards Venezuela, but then it turned back. But the U.S. Coast Guard has been tracking it, following it, etc. The tanker, as you very rightly pointed out for our viewers, was earlier known as Bella. And apparently, this tanker in its past has ferried Iranian oil to some other destinations, due to which the American registry, there are various registries of this kind, have blacklisted it, right? So that was the past.
All right, and moving on to another story then, and U.S. Ambassador designate Sergio Gore is set to arrive in India within days, and with New Delhi and Washington work to steady strained ties. A close aide to Donald Trump, Gore is expected to focus on repairing the relations hit by steep U.S. tariffs. He met Narendra Modi and S. Jaishankar last year.
All right, but then looks like it's going to be tough times ahead for Indian exporters as the clock ticks down on a crucial trade deal with the United States. Now, industry leaders, they are warning that January is really the decisive month to secure orders for 2026 summer shopping season. And without a breakthrough in trade talks between New Delhi and Washington, major labor-intensive sectors including textiles, leather and handicrafts, all of these risk losing massive U.S. contracts to global competitors. Experts are saying that if a deal isn't sealed this month, the impact on India's export revenue and manufacturing jobs, that could be severe. However, U.S. President Donald Trump continues with his tirade against India over trade talks and tariffs. Let's listen in.
I mean, I had India coming to me, sir, I've been waiting 5 years. We're changing it. We're changing it. India ordered 68 Apaches, and Prime Minister Modi came to see me. Sir, may I see you, please? Yes, I have a very good relationship with him. He's not that happy with me because, you know, they're paying a lot of tariffs now because they're not doing the oil, but they are. They've now reduced it very substantially, as you know, from Russia. We're getting rich because of tariffs, by the way. I hope everyone understands that.
All right, but even as Trump continues to target India, India's exporters are keenly awaiting the conclusion of India-US trade deal as the delay is hurting the exporters. Anjali gets more on the story. Anjali.
Indian exporters are voicing concerns over drying up of US orders ahead of the crucial summer season. Now, January is the month where a lot of orders for the upcoming summer seasons are placed, but Indian exporters are at a competitive disadvantage with the tariffs being as high as 50% compared to lower tariffs in the other countries. Now, Indian exporters have been taking cuts on their margins in order to sustain the long-term relationships with US buyers, with a 50% reciprocal tariff imposed by the US administration on India. Indian exporters have had to give out massive discounts to their buyers as high as 20% in some cases, and a part of it is also being absorbed by the buyers as well. Now, while there has been some diversification taken up by exporters across leather, textile, gems and jewelry, all of these sectors, these have aided business, but what the exporters have come to realize is they cannot completely make up for the shortfall in the US orders. The US does make up for a much larger portion of the exports for all of these industries, and therefore even with diversification there is a considerable drop in exports from these sectors to the US that we've seen. For example, if we consider textile, then in October 2025 the exports declined by 12.9, about 13% year on year, and for gems and jewelry also the exports were down 30.57%. In fact, CRISIL estimates that US tariffs are going to cut the Indian leather industry's revenues by 10 to 12% this fiscal year. Now, if you compare Indian exporters to the other neighboring countries or the other competitive countries, then we are at 50% tariffs compared to the 20% on Vietnam and Bangladesh and 19% on Indonesia and Cambodia. So, which means there is a considerable competitive disadvantage for Indian exporters, and that is what they are currently battling, and it is crucial for them to secure some orders for this upcoming summer season.
All right, thank you, Anjali, for those updates. But with that, time for a very quick break. We'll be time now to take a look at how the Asia Pacific markets have opened up. And it's a rather mixed day coming in for the Asia Pacific front. This after Wall Street closed in the red mostly on growing geopolitical tensions and also comments coming from Trump. Now, let's take a look at all of the indices, how they are faring. Now, China's Shanghai index that continues to trade about 0.2% lower, 4,070. That's the level, key level that it's holding on to. Hong Kong's Hang Seng index also trading more than 1% lower. Deep cuts coming in over there. 26,180 is where it's currently trading. Japan's Nikkei also continuing to trade in the red, down about 0.7%, 51,590. Key level that it is managing to hold on to. So that's about some of the key indices. Apart from them, S&P ASX 200, Australia's index, that's the one that's actually trading in the green. Absolutely flat moves over there, but yes, at least managing to hold on to that green shade. 8,700, that's the level where it is at. And other than that, there's also South Korea's Kospi index, which is also trading just about 1.5% higher, 4,618. That's where the index is currently trading. So good moves over there. But if we talk about the Nifty, yesterday we gave up that 26,150 level also, ended absolutely, close to that level, 26,140. That is where the Nifty ended. And for today as well, just mirroring the Asia Pacific front, we're expecting a very muted start and also in the negative trend. That trend is likely to continue down about 53 points on the Nifty implied open. So yes, Srishti, a mildly negative start is what we are penciling in for the Indian markets yet again. So that fourth day of softness is likely going to continue.
All right, let's watch out for that because 26,100 remains to be a crucial level for the markets. But how did the markets wrap up just yesterday? Let's do a recap and let me take it across to Snehi for all of the details.
Well, yes, taking a look at the market move, it's been an absolutely flat day of trade. 0.1% cut on the Nifty, and 26,140 is where it shut shop, so slightly below the 26,150 mark. On the flip side, Sensex too saw a 0.1% cut. It was Nifty Bank that saw a little bit of a recovery from the day's low, but nonetheless managed to close only with cuts of 0.2%. Let's talk about some of the winners and losers from the Nifty 50 group of stocks. Titan, the clear outperformer, of 4% uptick on that stock, close to that mark because you had very good set of quarter 3 updates coming in from the company. The entire IT pack was shining. It was the day of the IT stocks. IT was the top sectoral gainer, and a 2% uptick on Nifty IT on an intraday basis alone, and that was held up by names like HCL Tech, a 2% uptick over there. You had Wipro, Infosys, TCS, Tech Mahindra, Persistent Systems, OFSS. All of them have seen very good moves. In fact, Persistent Systems was up about 4.5%. So the mid cap and the large cap IT names have done exceedingly well. Geo Financial was another name that stood out from the Nifty 50 group of stocks, along with an Apollo Hospital, second straight day of gains for that one. On the flip side, intense pressure on Cipla, the top sectoral loser, and slightly more than a 4% cut on that name on the back of 9 observations being issued by the US FDA to its German arm. Followed by that, a lot of weakness in Maruti Suzuki, about a 3% cut there, along with Tata Motors PV, Power Grid and Maxell. So overall, Nifty Auto as an index did not do all that well, and in fact it was the top sectoral loser too. The broader end of the market was able to catch on to some of the market moves that we were seeing in terms of a little bit of a recovery coming in. The advance decline ratio closed absolutely even Steven. So the broader end of the market from the mid cap and the small cap end did very well for itself, about 0.4% to 0.5% uptick on both of these indexes. Sectorally, it was IT that was the top gainer, along with pharma and select media stocks. On the flip side, you had metals on the flat line with big cuts on auto, realty, PSU banks, followed by energy, bank and FMCG. So it was names like Torrent Pharma, Mankind, Wockhardt Pharma, Ipca Labs that kept the pharma pack in focus. But on the flip side, Motherson, Exide, M&M, Maruti, all of these were stocks that kept the autos pack under pressure. From the broader end of the market, you had Tata Elxsi, a 9.5% jump over there. Elecon Engineering ahead of its earnings was up 8%. You had Sonata Software, KPIT Tech, Tata Technology. So overall, the entire IT basket was shining bright. The ER&D stocks were doing well. On the flip side, big cuts on M&M Financial Services, Ola Electric, Sumitomo Chem and Maharashtra Scooters. These were some of the top 500 Nifty losers. So with that, that is how the market session panned out. 26,140 is where the Nifty closed, and all eyes are going to be on what the market performance is on the day of the weekly Sensex expiry.
Alright, so let's watch out for all of that. But which are some individual stocks that are likely going to be on the move today? Meryl is here with just that list. Meryl, over to you. Good morning.
Right, so these are some of the stocks on our radar today, some on the back of their third quarter updates. Let's take a look. First up, IRB Infra has reported their aggregate toll revenues for the month of December growing 12% year on year. Moving on, Tata Steel reported its best ever quarterly crude steel production, with India production surging 12% year on year and India delivery volumes up 14% year on year. However, delivery volumes in Netherlands and the UK were declined 9% each, owing to seasonal factors, subdued market conditions, and enabling works for the EAF project weighing on their performance. Up next in the regular news, HUDCO India has signed a non-binding MOU with the government of Chhattisgarh to provide financial assistance for up to 1 lakh crore rupees over the next 5 years for housing and infra projects in the state. Continuing, Gland Pharma has received US FDA approval for its ANDA for olopatadine hydrochloride ophthalmic solution that is a therapeutic equivalent to Alcon's Pataday and is used to treat ocular itching associated with allergic conjunctivitis. Finally, Infosys, along with Cognition, has announced a strategic collaboration aimed at accelerating the AI value journey for global enterprises. So these are some of the stocks in focus today. Back to you in the studio.
Thank you so much, Meryl, for getting us all those details. But with this, let's also tell you some of the other counters that you should be watching out for. And first up is Balaji Mines, as a positive news flow coming in for this particular company, as the company has received an eligibility certificate under the Maharashtra government's package scheme for incentives, where this will entitle its Unit 4 mega project to incentives totaling worth 258 crores. So let's watch out for Balaji Mines in trade today. Midwest is going to be in focus as well, as the company has secured a significant 30-year quarry lease work order from government of Andhra Pradesh right now. And this is the extraction of the colored quartzites blocks over an extent of 51.92 acres in Prakasam district. So let's watch out for this counter. Other than that, it's going to be another interesting day for Zaggle because of positive news flow yet again coming in, as the company has signed a perpetual agreement with Cubastian Consulting, and this will provide the mobile device procurement and leasing to their employees through the employee purchase program. Lock-in period ends for LG Electronics as well as Cryzac, and for Cryzac it's a 60% of the lock-in that will end today. So that's going to be interesting to see what happens to the stock price, because just yesterday the stock ended flat. And lastly, Lloyds will be in focus as well, as today we have the board meet where they will mull the rights issued today. So let's watch out for these counters in trade.
Absolutely. Lots of counters to track today, but there are also several cues that we must keep an eye out for, and Snehi is here to take us through all of them.
Well, yes, lots of cues to watch out for. Thursday means it's the weekly sensex expiry, so expect some volatility in a market that has been largely flat and range-bound in the week so far. Other than that, the India-EU FTA talks are going to be very important. It's going to be an important development to watch out for which way it goes. The talks are going to be held in Brussels from 8th Jan to 9th Jan, so watch out for that. But shifting focus to some global cues, from the US, wholesale inventories, initial jobless claims and trade data will be out. Eurozone, you'll see PPI, consumer confidence, unemployment data, and the ECB 1-year and 3-year CPI expectations will also be released, so keep a close eye on that. But shifting focus back home, we've kick-started the earnings season with non-nifty companies, and adding to that list, you have transformers and rectifiers and Elecon Engineering to watch out for on the back of their Q3 FY26 earnings. In terms of corporate action and board meetings, keep a close eye on NHPC and Ugro Capital. The board of both of these companies are going to be meeting to mull fundraising, and Lloyds Enterprises board is going to be mulling a rights issue, so watch out for announcements for all three of these stocks concerned. And lastly, the lock-in period is going to be opening for LG Electronics India, recently listed, wherein 2% equity comes out of lock-in, and for Cryzac, that's been listed for some time now, 60% equity is going to be coming out of lock-in, so watch out for any adverse reaction on this stock if at all. But yes, keep a close eye on all of these cues.
All right, thank you so much, Snehi, for getting us all those details. And as the US economy heads into 2026, questions are rising over how long the Federal Reserve can stay dovish despite strong growth and lingering inflation risk. Former RBI Governor Raghuram Rajan believes that the Fed is prioritizing the jobs and affordability, but warns of risk building beneath the surface. Let's listen into an excerpt of that exclusive conversation as a part of the latest edition of the interview with Aisha Faridi.
If you look at estimates of growth for next year, it's above potential, at or above potential. So it's not as if the Fed is particularly restrictive. What seems to be its focus is more on the sort of K-shaped nature of the US recovery, that there are people who are hurting, especially in the lower middle class. The affordability crisis is an important issue. And so it's trying to keep their jobs. Though, of course, another answer would be to try bringing down inflation, which hurts the people at the bottom much more. But it's chosen one over the other of its mandates. In the meantime, the US economy is chugging along really strongly with enormous investment in AI-related stuff. And with the upper middle class really buoyant on the backs of enormous stock gains and housing prices remaining stable rather than, coming down because of high interest rates and low volumes. So all in all, it looks like things will start picking up again in the US as we go into next year, barring something unforeseen on the political front, which of course can never be discounted.
So there's a greater likelihood, in your view, that the Fed continues to stay dovish?
I think the Fed at this point has done enough to claim that it's bought insurance for the economy. It's probably been more dovish than certainly I would have been under the circumstance. But again, one of the issues it's battling with is very, very gray data because, as you know, the government shut down, prevented data on the labor market coming out. So in that kind of situation, it's preferring to be a little more dovish and hopefully buy insurance for the economy. Of course, the risks are that it starts precipitating excess inflation, but also excess credit growth, and that's a concern.
All right, so stay tuned for the full conversation with Raghuram Rajan right here on ET Now. But with that, time for a very short break. It's time now to take a look at some macro trends that are emerging. And tariff turbulence, that has failed to dim India's growth prospects, really. And the first advance estimate for FY26 show that the GDP growth is pegged at 7.4%, which is much higher than 6.5% in the previous fiscal. Now, the 7.4% growth outlook is also higher than what RBI has forecasted, which is at 7.3% growth for the current financial year. Meanwhile, some slowdown is seen in nominal growth, which reflects the total value of goods and services that were produced within a country during a given period of time at current market prices. That is expected to fall to 8%, that's against 9.8% last year. Now remember, this data is crucial as it forms the base for all of the budget 2026 calculations. Now if you look at the fine print of the first advanced GDP forecast numbers, manufacturing and services sectors, they stand out as the major sectors behind the uptick in growth projections, with both of them expected to rise at 7% and 9.8% respectively. Meanwhile, there's the agriculture and construction sectors, which are likely to see some sluggishness this time around. Mining too is expected to hit a rough patch, with growth coming in at minus 0.7% versus 4.6% last year. On the other hand, we have private investments for the year, which are expected to expand by 7.8% compared to 7.1% last year. In fact, my colleague Prakash filed this report earlier with all of the details and the number crunching. Let's take a look.
Well, the first advanced estimates of GDP for FY26 is reflecting the resilience of the Indian economy amid challenges from external sectors. We are facing tariff-related disruptions along with geopolitical uncertainties, and therefore, with 7.4% GDP growth, which is reflecting the strength of the Indian economy, it has ensured that India will remain one of the fastest major growing economy in the world. Along with that, these numbers were keenly watched and very crucial for the government, as it will be taken into account before announcing policy-related measures in the upcoming budget. It is important to note that the MOSPI is expected to announce new base year for GDP calculation next month, and therefore these numbers hold significance. It has a positive impact of massive rate rationalization under GST. We have seen massive rate cuts, and therefore services growth, consumption-led growth has been factored in. If you look at the sectoral performance, financial sector, real estate, professional services, public administration, defense and other services growth seen at 9.9% in FY26, whereas trade, hotels, transport, communication, services related to broadcasting sector has seen estimated to grow by 7.5%. Along with that, manufacturing and construction in the secondary sector has been estimated to grow by 7%, whereas agriculture and allied sector growth seen at 3.1% compared to 4.6% in FY26, which could be a major area of concern for the government where there is scope for growth. Back to you.
All right, thank you so much, Prakash. But let's also listen into what experts have to say on this number.
We were expecting GDP growth of 7.5%, and the number has come at 7.4%. So it's broadly in line with expectations. But if I look at the breakup, what surprised me a little bit was the growth estimate given for consumption and investment. So if we look at the GDP growth number given for consumption, basically it is factoring in that there would be some moderation in consumption growth in the second half of the year, which I found a little surprising because we were expecting the consumption growth momentum would pick up further because of GST rate rationalization, lower inflation and all those factors.
surprise in numbers. So the 7.4% number is perfectly in line with expectation. The sectoral trends are also quite in line with expectation. You are absolutely right that compared to the 10 odd percent nominal GDP growth focus, now it comes around 8%. It's a challenge to maintaining the fiscal deficit ratio target. Also, the government these days are quite committed on the public debt to GDP number also. So it's a challenge for both.
All right, so that's about the macro trends and the GDP forecast. But now let's put the spotlight on the aviation sector. Now, India's government has asked Indigo, Air India, SpiceJet and Akasa, all of these airlines, to provide data on average fares that they are charging. That's as per a document that we have seen. And as antitrust authorities, they're also investigating unprecedented travel disruptions in December that we saw. Charu is here with the details. Let's take a look.
As per sources privy to the matter, the Competition Commission of India, which is the antitrust watchdog, has asked the aviation regulator, that is the Directorate General of Civil Aviation, to relay some data back to CCI. This data includes the fare of affected routes during the entire Indigo fiasco that took place very recently. So let's understand the entire issue chronologically. First, some time back, Indigo had cancelled its flights in massive numbers because of its non-implementation and non-compliance of the DGCA pilot fatigue norms. It was ill-prepared to do the same. The roster was not prepared, and it led to massive disruptions in flight routes and operations across the country, leaving a lot of passengers stranded on several airports. After this, the DGCA decided to take some action, formed an expert committee. On the other hand, there were also allegations that Indigo was giving seats at much higher prices, and when the entire thing was happening, the fares of prices in the affected routes rose up even in the airlines other than Indigo. That includes Air India, SpiceJet, Akasa and many more. So CCI, in its probe of abuse of power against Indigo during the entire fiasco, is now asking for information regarding the change in fares during the affected days in other airlines, and also about Indigo's own prices during this time. To sort of get an entire idea about the whole issue, they have asked DGCA to get this information from the airlines and then give it back to CCI so that it can continue its probe against Indigo's entire fiasco that happened a few weeks ago.
All right, thank you, Charu, for those details. But let's keep it with the aviation space. And in an exclusive conversation with ET Now, founder and CEO of Akasa Air discussed about the listing plans for the company. He also sees the company getting listed in just about 2 to 5 years, as he believes that the listing needs profitability, not just top line. Let's take a look.
What I've said is a 2 to 5 year time horizon. And I said that maybe 2 or 3 months ago, so you can subtract 2 or 3 months from that 2 to 5 year time horizon. But Sajid, it's more than just the top line, right? I mean, investors are not necessarily investing in a company that just has top line growth. You have to show bottom line growth as well, and that will take a little bit of time. And so we maintain this 2 to 5 years, or a little less now than 2 to 5 year horizon, because we want to solidify not just the top line, but you want to solidify your operating cash generation. You want to solidify your EBITDA margins, your P&L, PAT positive, etc., etc. And that's just going to take a little more time.
All right, and let's move on. And 2025 was a big year for the IPO market. But what about 2026? Well, that's the big question on every investor's mind. And to decode this, ET Now's Anurag Joshi spoke to Vijay Shankar, who's the managing director of Kotak Investment Banking. Let's listen into what he had to say.
Our belief is we should probably touch 25 billion, which will be a fantastic 20% plus growth over 25, and that will make it a record year in calendar 26.
If we see the overall ECM volumes, there was a dip last year. You see that picking up. You see probably QIPs, the pace of QIPs rising in 2026.
So ECM in 25 was driven more by IPOs. There was a dip both in sell downs and QIPs compared to 24, which is why the volume fell down from 73 billion to 55. That was a roughly 18% drop. We expect the ECM activity to go back to 24 levels to reach the previous record. So while IPOs will be roughly about 25 billion, and I would think there's a positive bias to it, the QIP will be marginally higher, and blocks will probably go back closer to the 24 level. So the 26 IPO ECM activity will be driven by IPOs and blocks, while QIP will still be muted.
In terms of the sectors, which ones are you more optimistic about companies raising money through IPOs?
The top three sectors to our mind would be the new age companies, particularly the internet companies, also financial institutions group, which is your banks, NBFCs, insurance. That will continue to be an important segment. SBI Mutual Fund, as you said, has already made an announcement. And consumer will probably be an important one. We are seeing industrial being equally important. So these 3-4 sectors will drive.
New age is again being a very promising sector. How will that deliver in the capital markets in 2026? We had Zepto; they have pre-filed their prospectus confidentially. So going ahead, are you seeing more names? Probably which names can be expected in 2026?
New age companies have driven the IPO returns. I expect that to kind of continue.
All right, then on to some more news updates. Now, Vedanta chairman Anil Agarwal has announced the death of his son Agnivesh Agarwal following a skiing incident in the United States. Agnivesh, he was 49. He was recovering in a hospital before suffering a sudden cardiac arrest. Calling it the darkest day of his life, Agarwal remembered his son as a compassionate leader and a close friend. Agnivesh chaired Talwandi Sabu Power and also served on several boards of Vedanta.
Now and on to some of the Q3 updates now. And Tata Steel has come out with strong Q3 updates, where this time around we have seen the European business has come in a bit weak, but definitely a lot of these other factors that have done very well, especially the domestic business. But let's get more details on how the internals are looking like. Let me take it across to Ashesha for all of that. Ashesha.
Well, yes, Tata Steel's India operations has reported strong performance yet again in the third quarter of FY26. Production, in fact, for India operations has seen an increase of about 12% on a year-on-year basis, and the company says that this is the best ever quarterly crude steel production that the company has reported ever. Remember, this was aided by higher production at both their plants. One is Jamshedpur plant and the other is Kalinganagar plant. As far as deliveries are concerned, that too was very strong. India deliveries reported a growth of about 14% on a year-on-year basis. Domestic market sales were on the higher side, and that aided sales volume growth in the quarter gone by. Now, as far as the European operations are concerned, it was weak but largely in line, and most of it was already factored in. Now, Netherlands delivery volumes have seen a decline of 9%, one on account of seasonal factors and also on account of market dynamics and how the market is positioned in the Netherlands market. UK, meanwhile, on the back of transitioning from blast furnace to electric arc furnace, is seeing some impact in the third quarter. So delivery of operations volumes in UK saw a decline of about 9% on a year-on-year basis. So yes, India operations continues to show resilience. This has been the case for the last several quarters, and that trajectory continued in the third quarter as well. Morgan Stanley, meanwhile, has maintained their overweight stance on the stock with a target price of 200 rupees per share. So yes, operational performance was very strong. Remember, steel prices have also started rising at the end of last quarter and at the beginning of this quarter. So that is also likely to aid earnings for the company going forward. But all in all, strong operation update from their India operations.
Thanks, Ashesha, for that update. Strong India operations, that's the word coming for Tata Steel. But let's move on, and all eyes are now going to be on the budget. And ET Now's Budget Yatra rolls into Chennai this time inside one of India's key manufacturing engines. Automakers and tyre makers, they've flagged tariff stress, raw material shortages, and also R&D incentives and some inverted duties as key concerns they want to highlight for the budget. Jude gets us the ground report on the industry's budget wish list.
On our Chennai episode of Budget Yatra 2026, join me as I hit the road and get a pulse of the movers and shakers of India's auto component sector. So from the impact of the Trump tariffs to supply chain bottlenecks, how is a 100,000 crore rupee industry getting by? And more importantly, what does the component manufacturing ecosystem want from Budget 2026? Find out all that and more on the Chennai episode of Budget Yatra, January 8th and 9th at 4 p.m. only on ET Now.
Alright, now let's talk about the consumption space as that will be in focus on the back of a positive note coming in from Citi. The brokerage firm sees sequential improvement in the growth within staples for the Q3 along with reversals in profitability trends. Snehi joins in with more details. Snehi.
Well, yes, so the consumption space has been in focus on the back of Q3 updates that we've been receiving for many days. And today, Citi has come out with a note on their take on what the updates have been so far and what the overall expectation is for the sector in Q3. So they are expecting a sequential improvement in growth trajectory of Indian consumer staple companies, and this is attributable to overall reduced pricing across multiple product categories because of the GST cuts that they had seen, increase in grammage and net revenue. Low unit packs in select categories are expected to do well. And of course, the partial recovery post-inventory destocking that was seen in the September to October period as well. So these are going to be some important factors to watch out for. And they're also seeing that they're expecting a reversal in the overall profitability trends because of all of these factors that are supportive. And they're estimating an EBITDA margin for the stocks in their coverage to remain constant on a year-on-year basis versus the declines that we've seen across the board for most of the staple stocks in the last 4 to 5 quarters. So that is another positive, that at least the margins are expected to be constant on a year-on-year basis. On the cost front, they believe that commodity costs have eased and the input costs are now much lower across various commodities, and that could be another positive trigger for a lot of these staple companies, and they will continue to monitor whether the uptick in demand sustains over the medium term that we have seen temporarily because of the GST cuts. They remain selective and believe that companies with self-help initiatives remain better placed on a relative basis. So sectorally, they prefer the food and beverage space right now over the home and personal care space. Their top picks are Britannia, wherein they have a positive catalyst watch as well, Godrej Consumer and Varun Beverages. And they also say that Marico and Tata Consumer, they're expecting strong growth from both of these companies as well. So that's Citi's take on India's consumer staples, and they believe that Q3 could be a decent quarter for a lot of the staple companies.
All right, thanks, Nehi, for that update. That's the check on the consumption space. But now let's also put the spotlight on the power generation trends we have seen in the third quarter of FY26. And Elara has come out with a report. And as pretty much on expected lines, it suggests that power generation, it remained absolutely flat during the quarter gone by. In fact, saw a decline of about 0.3% on a year-on-year basis. But remember, December did see some uptick, and that weaker output that we saw between the October to November period, that was offset by the sharp rebound that we saw in December. And this December demand is up about 7.6% on a year-on-year basis, which has taken the demand to 241.2 gigawatts. That nears the FY26 high, that is 241 gigawatt. Now, speaking of the demand surge that we saw in December, it was given the increased use of heating appliances we saw in December. So yes, good moves over there as far as the December month is concerned. But October and November, they, like I said, have seen a weak demand. If we talk about electricity volumes, they have also seen an increase of about 11.9% on a year-on-year basis on IEX. Next up, let's talk about some of the top picks that Elara has in the power space, and these are the likes of CESC, NLC India, NTPC, and so yes, that's about some of the top picks. But let's talk about power generation trends in detail for the months gone by. For October, we saw a decline of about 5.9%. In November too, it was down by just about 0.9%. However, in December, we saw an uptick of about 6.5% to that 151 billion units level. So yes, a good move over there, which has offset the lower trend in October and November. This is also the FI 26 high that we saw. So yes, good moves over there, and we did see a prolonged monsoon in Q2 as well. So yes, all eyes are now going to be on whether or not we see an impact of this on the third quarter results that all of these companies are going to report. Yes, so December did offset the weakness we saw in October, November, but now let's watch out for whether or not this also happens to be a factor in the results that are going to start trickling in very soon.
All right, let's watch out for that. But with this, viewers, we are completely timed out in this edition of Market Cafe. It's a goodbye from me and Kanishka and the entire team who put the show together. Thank you so much for tuning in.